Here we go. Good morning, everybody, or afternoon or evening, depending on where you are. I've been reminded. Great to have you here today. As you may or may not know, we've been talking about I've been talking about a book deal that I've been working on for 8 months. That's right. We started this back in November. And so, and the good news is last Friday, we finally got it done. A lot of pain, a lot of suffering, yay, but we got it done. And so today I'm sitting in, offices in King of Prussia, Pennsylvania, which is about 30 minutes from the airport. Beautiful area of Pennsylvania. And, we've got a 35,000 square foot warehouse here and, along with some corporate offices. And so I'm holed up in one of the offices right now, doing this webinar. So, so it's been amazing to get this deal done. In just the first week, my partner Kevin and I, again, we got this done last Friday. And so wires started going out, everywhere on Friday. The last wire went out literally 4 minutes before the end of the wire window, which is 4:30 p.m. here. And so at 4:26, the final wire went out last Friday afternoon. And so we started this morning, as true owners of the business, Monday. And so I came out, I'm flying out here generally on either Sunday night or Monday morning, depending on the availability of flights. And then I go home, generally on Thursday. Last week I was here Monday through Friday, working to get the transaction done. And, then went home for a day and a half and came out here Sunday night, for this week. So all that's good. What I want to do is kind of walk you through this transaction. All right. I know, each of you are here to go acquire companies. This transaction was a little different than normal. And I guess that's the first caveat right there. Every transaction in your entire life, whether you do one or 100 of them, are all completely different. All right. So please don't take something that I say here and get discouraged because, oh my God, if I have to do that, I'll kill myself. Or, take something that worked and say, well, it worked in his deal, it'll have to work in my deal. It might not. So, every deal is absolutely different. Every deal has to be tailored towards what you're trying to accomplish as a buyer, what the seller is trying to accomplish. And I can't overstate the importance of that. There are two people in any transaction. And it is incredibly important that you put yourself into the shoes of the seller. The only reason that Kevin and I got to buy this business is that the seller became convinced, rightly or wrongly, but he became convinced that we were going to take care of his brand and his people better than anyone else he was talking to. It was not a matter of money. Obviously, we paid for the business, but it was not a matter of money. If he wanted more money, he could have gotten that. But, he might have gotten that with a strategic that would have closed the warehouse, fired all of his 35 people, and said, thank you very much. And, and the seller didn't want that. He wanted, his dad started this business almost 75 years ago. And, and he wants it to continue. And it just makes sense. So you put yourself in his shoes. The most important things in the hierarchy was the brand. I want this to survive. B, the people. I don't want somebody coming in here and all of a sudden cutting half my employees. And then third, the terms and conditions of the deal, the financing of the deal. And in his case, fourth, he wanted 100% out. 100%. He didn't want to take back a note. He didn't want to take back stock. His goals in life right now is to liquidate everything. And at the end of the day, not only are we buying the business from him, we're also going to buy this real estate that I'm sitting in right now. And that will happen as a second part of the transaction. And I am told that may happen by the end of this month. We have a signed contract. Financing is already in place, and we're kind of moving through that process. So let me go back to the beginning. Sometime in November, my partner in this was reading the Wall Street Journal. He reads the journal every day. I used to do that when I was a research analyst on Wall Street, but have not touched the Wall Street Journal in God knows how long. It's just too expensive, for me to do it personally. I just, it's a waste of time for me. Anyway, for him, it's like the Bible. I mean, he's there every morning, in the Wall Street Journal. And he saw an advertisement from the seller of this business, just putting it out there. I've got a $30 million business. I'm, trying to sell it. Whatever the ad said, it caught his attention. And Kevin contacted Tim, the seller, and started to have a conversation. And one of the first questions Tim asked was, are you a broker or are you a principal? And Kevin assured him, no, I'm not a broker. I'm a principal. We're looking for a business to buy. And he gave a little bit of his background. He's been involved in many businesses over time, and so that just began a conversation. A couple weeks later, Kevin gets in the financials, takes a look at them, and gives me a phone call. He said, Jeff, and I've known Kevin for almost 20 years. He said, Jeff, I see this business. I think this looks to me like a hell of an opportunity. Can you take a look at it and tell me what you think? So he sent me the financials. It took me all of about 30 seconds to figure out that, Kevin, I think we can buy this business, and I think we can buy it for no cash down. And started talking to him about why I thought that was the case. And so next step was, all right, so we're both interested in taking a look at this business. Next step was go to a letter of intent. We had some information on the company, but frankly, not a lot. And so, Kevin and I started talking about, okay, what is this thing worth? I mean, you're doing 31 million in revenue, but you're losing a couple $100,000 a year. It's been, Tim, the owner, really hadn't been in the business, actively managing it for at least 5. And I'm thinking more like 10 years. It's been a very long time since they've had active management here. And yet, you've got an existing president, chief financial officer, a chief head of IT, who does all their digital stuff, and, head of sales and marketing. So you've got 4 senior executives already in place. Tim really served no purpose in the day-to-day management other than, he'd get the reports and he'd type back a, one-liner kind of response. Oh yeah, that looks great kind of stuff. And half the time he told us he doesn't even read the reports. So, really, Tim was not involved in the business. So what you've had is a caretaker management team who's been on cruise control because there's nobody at the helm saying, hey, we got to go that way. And this is how we're going to do it. And you do this and you do that and just delegate it out and make it happen. Nobody's been doing that for a very, very, very long time. So, and therein lies the opportunity, of course. And that's what I loved about the business, frankly. I love the fact that it was not making money. Okay. And I know if you do all the spreadsheets that we put together, and you come down to your coverage ratio and it's negative, that's not a good thing. I understand that. So you've got to, again, there are times when, you need that coverage ratio, and there are times when, you're probably better off if you don't have it, and that, which is rare, but that's one of these cases. So what can you do with $30 million of revenue? Do you think you can move margins by 2 percentage points? Just 2. That's $600,000 a year. You think you can move it by 4 percentage points? Forget about growth. Can I move margins 4 points? All of a sudden, this business is making $1.2 million a year. You put a multiple on that, and nice business. Also on the sales side, there hasn't been much direction. The person who does sales and marketing here, honestly, is fantastic. She's great, but she doesn't have an advertising budget. Advertising budget 5 years ago was about $90,000 a year. Last year was $18,000. You can't do anything on $18,000 in a $30 million business. So effectively, she had no advertising budget. And yet the business is still here. Yet the business is still generating $30 million a year. It's still the largest in its sector of health science and medical school textbooks. It's got a digital offering, although, you know, what we're offering today and what we're going to be offering, you know, potentially in just 30, 45 days from now is going to be dramatically different. So that's kind of the background of the transaction. So Tim and I were talking about valuation, and I told him, look, you know, I think that, you know, a business like this would generally be worth $6 million. Let's offer free. So I put together a term sheet for $3 million. We sent it off to Tim. All the process in the term sheet. I think I put this up, but it really didn't matter. And he accepted it. Robert, I'm going to unmute you to see if that does any better. I am in a place where the internet connection here is absolutely incredible. I downloaded a 35 megabyte file in 3 seconds yesterday. I mean, so it's not bandwidth. All right. So you can hear me now?
Yes.
Yeah. Okay. All right. This is just crazy. You know, Zoom has got a problem. Either that or my laptop's got a problem, and that's possible too. That'll be replaced here in the next couple of weeks. So, anyway, where was I? Where was I, Richard? All right, we were talking about the purchase price. So we got together on the purchase price, and yeah, thank you, Trent and Tim. And so, you know, we had an agreement there. And so that's good. So we started the diligence. We, started by, working with 2 people out of the 4-people management team to start getting information. We flew down here to, the King of Prussia and sat down with the president and the chief financial officer. Tons of questions. And, I started putting together the data room and used a Zoom box, and, there we go. So we started on the due diligence process. The long and short of it is that we started talking to lenders. I put together a lender presentation, which I know is up on Facebook. And so we started going through our due diligence lists. We started, creating the data rooms, figuring out what information we needed, put together a thing for the lenders, and sent that out to about a dozen, mostly asset-based lenders. In round numbers, about half came back to the deal because the company's not making any money. Okay, great. The other half came back and says, we think we can do the deal, despite the fact it's not making money. And, but we need more information, obviously. So we started working with that other half a dozen lenders, getting them the information that they needed. A couple more dropped out because, we were not putting in any money. I mean, I made that clear up front. This is a cashless deal, guys. We've got this asset and that asset and that asset and that asset, and that gives you more than enough coverage. It probably gives you 2-to-1 coverage. And what I need in this deal. And what I need in this deal is at that time about $3.2 million. So we ended up with 3 or 4 lenders. We got 4 term sheets, all of whom wanted to do the deal. One of those term sheets was from a lender that just does receivables. They don't do inventory. And, we looked at those advance rates and what we could actually get on that. And, we had to kick them to the side. The three others, we went forward with, and chose one of them to, do final due diligence and go to closing. So we were supposed to close this on March 1st. We are now July 2nd. So, 4 months ago, we were supposed to close this deal. And the original lender, yes, I am recording this. The additional, the lender that we chose, went through this whole process with them. And we were 6 days from closing when I get a call from the lender. And in fact, you'll get a kick out of this. I got a call from the lender, and I was actually at a shooting range. I had taken my grandson, and if you don't like guns, don't email me. But, I had him at a shooting range where, he was, just really wanted to, shoot a pistol that actually comes from World War I. My grandfather gave it to me. And anyway, so, we were doing that, and I get this phone call. And so, we put down all the guns. My grandson and I leave the area and come out so I can actually take the call. And was told that the credit committee for this lender rejected the deal. They were not going to be able to move forward. To which I, asked rather heatedly, so what's changed between the time that you told me you could do this deal and now? What's changed? I mean, you had all the numbers to begin with. The numbers are still the numbers. You knew the seasonality of this business to begin with. The seasonality is still the seasonality. There's nothing that's changed in here. How can you possibly walk away from this deal? And they said that the credit committee couldn't get comfortable with the seasonality. And basically, I used some expletives and said, again, you knew this before you got started. I can't believe you're going to, walk out on this deal 6 days before closing. Nothing we can do. But he said, I suggest you call this guy. He's a good friend of mine. They do deals that, I've done a lot of seasonality stuff. And so that was the end of the first lender. I called his buddy. Remember, I had 4 term sheets. One was from the guy that couldn't do inventory. So I had 3 effective term sheets. One of those just went away. So I called this other guy. Oh, yeah. We handle seasonality all the time. We've done, dress companies and apparel companies and all these things. We understand seasonality. Great. Send him all the materials. No, we can't do the deal. At least he told us up front. Why not? Oh, the seasonality here is just amazing. I mean, you realize some months your return rate is more than 100% of sales? Yeah, I know that. Mm-hmm. Right. Because, you sell the book in January, and 20% of the books come back in March, and you're not selling books in March, not many. So you sell $1 million in March and you get back $1.2 million. All right, so your March sales are negative 200,000. Is that a problem? Yeah, that's a problem. And, we've never seen anything like this before. They're gone. So I still had my 2 guys. So I went back to the second guy. Said, sorry, didn't choose you the first time, but we're back. And, are you still interested in doing the deal? This is what we need. And they ask all the obvious questions. Why the other guy pull out and blah, blah, blah. So he said, okay, we'll take it on. We'll update your term sheet. And at the same time, of course, COVID had just started. Now we're in March. COVID had just begun. All right. Remember March? And before the masks and all this crazy shit. COVID had just begun. And so we go through this process with this guy. Now, I've known this sales guy for this lender for Lord knows how many years. All right, many, many years. And so I was a little disappointed at the front end that I didn't go with him initially just because of that relationship. But frankly, the deal was better, with the guys that we went down the road with. So we started this process again. Went through all the diligence, went through everything. Everything's looking good. We get our paperwork. We finished the stock purchase agreement. So we've been working with the lawyers and the stock purchase agreement all this time. We finish it. We've signed it. All right. We've signed all the agreements on the seller side. Completely done. And by the way, in the middle of this, during COVID, the seller came back to us. He said, look, obviously COVID's going to be a big deal. All right. And, I really want to protect my people. And so I'm going to reduce the purchase price. I'm going to kick in $200,000 for you guys to help take care of my people. So the purchase prices went from 3 to 2.8. Okay. Thank you very much. Get down with the other lender. The other lender approves us. Second lender approves us, right? And so we sign all the paperwork with the second lender. I mean, we've got the loan agreements, we've got the guarantees, we've got every single document executed. And so the next process is that we need to load up. This is an asset-based lender, so in essence, they're going to mirror our accounts receivable system. Every time an invoice goes out, we let them know. Every time cash collection comes in, it's going to go into a lockbox so they know about it. Every time we have a shipment that comes back and we have to give a credit to the customer, on a daily basis, we let them know. So the initial process was to upload all of our invoices that are outstanding, which is something in the order of 12,000 invoices. So we ship that over to them and, do some sort of, I don't remember what it's called. Anyway, we upload all this information into their system. Okay, it takes them about a week to figure out how to handle all that information, but finally they do. And, they start spitting out some numbers that kind of conform to, what I anticipated, the analysis that I had done. And so then we go to the second step. The second step is on a daily basis, I send them a spreadsheet of every new invoice. I send them a spreadsheet of every new credit memo, and I send them a spreadsheet for every check or any other order, every check anyway, that has come into the bank account for the company. And so on a daily basis for 7 or 8 days, we're downloading all this information. I package it up. I send it to the lender. They're uploading it in their system. Everything's working great. All done. All right. And so I said, look, all I need to know now is what is my number? And what I meant by that is on the accounts receivable side, what's my lendable AR? I know what the terms are. What is my actual inventory availability? So how much can I borrow on inventory? How much can I borrow on receivables? Give me that number. Number doesn't come. We're then told that, they've got accounts receivable insurance. Now, I'll be quite transparent with you. I have never heard of accounts receivable insurance. Apparently, that has really popped up popular in the last 5+ years. So what this lender was doing, they would take my $5 million worth of receivables. They would wrap an insurance product around that $5 million, so that if somebody defaulted after the deductible, that the insurance company would cover their loss. Mm-hmm. All right. Makes good sense from a business standpoint. I understand that. And that cost them a couple of points, and that's all right, because the 13 points I was paying them would easily cover that, plus their cost of capital at Wells Fargo. So all of a sudden I hear that, one of our major customers, in fact, our largest customer, they're not going to be able to guarantee those receivables. That, that the insurance company's got a limit as to how much in receivables they can have out on any given company. Okay, on this company, they had $50 million on the street in insurance, and they were already tapped out. They couldn't take any more. And so the lender goes to the next insurance company. Can you do this one? Well, we got a lot of that out too. I can do 300,000. Now we got 2.8 million in receivables from them, but they can do 300,000. So I get the message back that, we're not going to be able to lend you on those receivables. That's not good. All right. So, but still, every day for 6 or 7 days, I'm saying, what's my number? What's my number? We can close this today. We got everything done on your side. We got everything done on the seller side. What the hell are we waiting for? I finally get a call from the lender. It says, our insurance company has told us they will not insure anything to a university. They will not insure 4 out of our 5 largest customers. The 5th is Amazon. They would insure Amazon. Isn't that nice of them? And I mean, effectively, that means there is no availability. We can't borrow on our receivables. That's our customer base. So the day of closing, or the day before, however you want to look at it, these bastards decided not to go forward with the transaction. They would not honor their commitment because an insurance product that was not part of the term sheet, the term sheet didn't have a contingency that says, oh, by the way, we have to get this insurance. The contracts did not have a contingency that said, oh, by the way, we have to get this insurance. So it blew up. It blew up. And so what do you do now? What do you do now? You know, looking at the other term sheet that we had, remember we had 3, 4, went down to 3, went down to 2. The other one that we had, I'm not interested in going down this route again with an ABL lender. We've got to do something else. So I called a buddy of mine in New York who just specialized in debt for, you know, his career, the same way I specialized in other things of mine. And I said, look, I need some money. I need to borrow $3 million. And I've got X in cash, X in receivables, X in inventory. This should be a no-brainer. But I can't, you know, but the ABL lenders, and I told him the whole story. He said, you know what? I've got some thoughts. So he introduced us to a family office out of Boston. And the family office, you know, is kind of interesting. The son runs it. The father is a hedge fund manager, did very well apparently. And he sold his hedge fund a couple of years back. It's got a pile of cash, and son runs a piece of that cash. And what they do is they will go out and do short-term loans or, you know, longer-term loans with companies that they like. And about 2/3 of their business is repeat, which is a good sign, right? Yeah. And so anyway, so we started conversations with them. And we realized up front this is going to be extraordinarily expensive money, but it would get the deal done. At the same time, we were having conversations with an SBA lender that Kevin, my business partner, had a relationship with. And in fact, that SBA lender had provided him with a loan agreement on another deal that he was doing last year that fell through because at the end of the day, the seller decided not to sell. And, you know, and that happens too. You can get right up to closing on a deal. And the seller says, God, I can't do it. I just can't sell it. And you're screwed. I mean, you're done. That's what happened to him. He said, but this is a great bank to work with. They're easy to work with, et cetera, et cetera. So we were talking to them simultaneously to talking with the family office. And on one Friday, and in fact, I told you about this whenever this happened, a few weeks ago. On one Friday, I executed 2 term sheets. I executed the term sheet for the family office, told them we're going to closing with you. I executed a term sheet with the SBA, and I said, I'm going with closing with you. The difference being the SBA lender had told us that the SBA loves real estate. And the only way that they would take on the loan was if we also bought the warehouse. And Tim, the seller, already had a contract to sell the warehouse. This was his last piece of real estate in his portfolio. He was liquidating everything. And he had a purchase price of $3 million. So Kevin makes some phone calls. Kevin actually grew up in this area of the world. Made some phone calls to some real estate folks he knows. And they said, basically, in this area, a warehouse of that size is probably worth $4 million. All right, and we're paying $3 million. I can live with that. So we went back to the seller and said, you know, if we put the real estate in with the business, we can get 25-year financing at 5.5%. We'd like to do that. And he said, fine. All right, glad to sell it to you guys. So we start down the road to get a contract to buy this piece of real estate. Now, again, we're going down these two paths at the same time. You know, I knew that the SBA path was going to take longer, just by its very nature. But we were getting them all the diligence stuff that they needed. All right. I knew that if we could get this deal done with just the business, not the real estate, that we could turn around and refinance with the SBA the real estate and the business. And so that's what we're doing. Now, what's the cost of that? Well, this lender required that the loan be outstanding for 12 months. Or if not, that we at least we pay interest for 12 months. And effectively, the interest rate's 20%. All right. So we went back and said, let me think about this. I said, how about you give us $3 million? We close. We pay the seller 2.8. We pay $200,000 in transaction costs. And we turn around the next day and pay you back $1 million out of our cash. Now you got a $2 million loan. And, you know, and we'll keep that outstanding or pay interest for the whole year. And so we went back and forth on that. And, you know, and ultimately Kevin came up with this, and, you know, I don't know if I shoot him or thank him, but he said, well, I tell you what, why don't we pay them, you know, the interest up front? We got to pay it anyway. We'll pay you $400,000 a day after closing. And there's a loan origination fee of another $100,000. We'll pay you $1.5 million the day after closing. And now you're out of our hair until we refinance it, you know, except for the reporting and all the other stuff we got to do. They accepted that. So that's what we did. We closed on Friday. We actually on Friday also wired to them the 1.5. We wired out $200,000 in expenses. We wired out 2.8 to the seller, and we're a done deal. All right. So now what do we do besides operate the business? Now we go back to the SBA lender and say, okay, SBA lender, good news and good news. Good news is we just bought the business. We own it. And they were shocked, to say the least. Second piece of good news is that we want to continue on with the $5 million loan commitment that you've given us. We have to change the name of the acquirer, and, you know, there's some nits and nats that we have to change, but basically the deal's unchanged. And, you know, one of the questions was, in the SBA world, you've got to put generally 10% down. Some lenders will require more, but generally 10% down. So, you know, on $5 million, that's $500,000. So we said, look, we just paid these guys down $1 million. Can that be seen as our equity in this deal? She said, yeah. Yeah, that's your equity. That's perfect. So we'll have a $5 million loan. All right. We will buy the real estate. We will pay off with the other $2 million. We pay off the other guys. All right. Oh, one little piece of tidbit that I missed that drove my CFO here almost into the ground. They also the family office also required we put $2 million in cash in a locked account. It's still our cash, ours being the company's cash, but we can't touch it. And so think of it this way from the CFO standpoint. We're sucking $2 million into that account. We're sucking out $1.5 million into expenses. And on top of that, we had another $180,000 of expenses over and above that had to be paid out the next day. So we just sucked out about $3.7 million in cash. He was not a happy camper, but they got it done. And so now, you know, when we close on the SBA deal, we'll take that $2 million, pay the guy off, the $2 million in the bank account now is freed up. We put that back into our account, and you know, we're now flush again, and the CFO will be happy again. So we learned 2 days ago that they believe they can get this deal done by the end of this month, end of July, which is astounding to me because everything else we'd already heard from them is it's going to be 60, 90 days. And, you know, and I had told Tim, the seller, I said, look, yeah, because when he saw the cost and how much cash was going out the door, he wasn't real happy either. I said, Tim, we had 2 choices. We could either do the deal this way, get it done, you get paid, and then second step is go do this SBA thing. And by the way, we're going to go out and raise $1 million of equity anyway. And so the business will be fine. Or we could have gone down the road with the SBA and not done this deal with the family office. It would have been another 60 to 90 days. They needed to do an appraisal on the business. They need to do an appraisal on the real estate. I have no idea what this business is going to appraise for. It's losing money. I'm pretty sure I know what the real estate will appraise for, but I don't know, you know, if the bank can go and finance this business. I just don't know. And so either, you know, we've got a sure deal we just closed today. I'm talking to them on Friday before these wires are going all over the place. We can close this deal today, or we can close this deal maybe in 60 to 90 days. And I said, I put myself in your shoes, and I'll tell you what, I don't think you can wait 60 or 90 days. This has been an up and down thing. We've already come to closing twice and been turned away. You want to do that third time? And frankly, I don't think I can do this anymore. I mean, you realize how much stress is involved in getting 4 lenders to approve a deal? 4. Normally, you just need 1. I've worked with 4 lenders and gotten them to approve the deal. And he said, you know what, you're right. Yeah, we got to get this thing done. You know, I trust you. You know what you're doing. Go do it. And we did. And we did. So that's the kind of the anatomy of the financial side. On the legal side, you know, we normally don't, we normally think that, you know, the lawyers out there, they just get stuff papered, we sign it, and we go down the road. Not quite that simple. We had already negotiated, you know, a full document for the stock purchase agreement. I mean, that had been done back in March or April, sometime back there. So, but the loan agreements, you know, the first lender that backed out because of lack of insurance, that was about a 10-page document. I didn't even turn it over to my lawyer. I just read it. You know, I've read enough of these. I just read it and said, okay, there's nothing in here that's going to bite me in the ass. I'm ready to go. I'll sign it. And we signed it and went down the road. Right? The family office, oh my God. Family office is out of Boston. They use a good-sized law firm out of New York City. Now, I will tell you, New York lawyers have an attitude unlike any lawyer anywhere in the country. I've dealt with them before. I hope I never have to do that again. And they required something new almost on a daily basis. Oh, now we need this. Oh, now we need that. Oh, we need a formal legal opinion from your lawyer that says you can do this transaction. Now, a formal legal opinion is a regular thing on a 50 million or 100 million or $1 billion transaction. Yes, you have that. And what the lawyer is basically saying is we've looked through, you know, all the corporate stuff. The people who are signing this document have the authority to do so. There's nothing out there that, it has not been disclosed that we found anyway. And it's a long document. I mean, it can go on 10, 15 pages about opining upon all sorts of esoteric crap that, if you're a lawyer, is important. Now, what does effectively mean for the buyer and the seller? Nada. Doesn't mean a thing, but it makes the lender happy. So, all right, so we did that. And in fact, my law firm, which is only an 850 lawyer firm, didn't have an office in Pennsylvania, and this company is incorporated in Pennsylvania. And so, as part of needing that legal opinion, they needed the legal opinion that this company could enter into this transaction. Well, my lawyers couldn't do that. So we had to hire Pennsylvania counsel to do that. And so we were lucky, though, in that, Tim already had Pennsylvania counsel. So we called the counsel and said, can you do this opinion letter that the lender requires? And he said, yeah, I'll need to get a document signed by Tim, because of potential conflict of interest. But if he doesn't have a problem with it, yes, we can do that. And so then we went back to the lender and said, okay, we've got Tim's lawyer that is willing to do this. Is that acceptable to you? And they said, sure. So he put together this nice long letter about this company and the ability of this company to do this transaction. At the end of the day, we finally got one more thing. And then we're done with that, right? Then they come back and say, oh, by the way, we need a legal opinion as to whether Jeff and Kevin can do this transaction. My lawyer says, Jeff, I have never, in my entire practice of law, written an opinion as to whether two individuals or the company that they just created can do a transaction like this. This is absolutely, their word for it is it's not market. I mean, that's what the lawyer said. Oh, this is not market, meaning normally you don't do this. We pushed back again, and the lender ultimately said, look, guys, we're not closing this loan without that opinion. Okay. So they go back to work. And I'm saying, okay, now how long is this going to take? And he said, well, it'll only take a couple of days. But, it's just racking up legal fees. So at the end of the day, they deemed that we were able to purchase this great deal. That's nice. And so finally we got all the documents done, signed, sealed, and and delivered. So, but think about the cost of this. When we started, realized we did this deal 3 times. So that's part of the reason. When we started, I penciled in the same number I have given you guys forever as penciling in for legal expense. Remember what that is? $50,000. That's what I penciled in. All right. And that's a reasonable, and if we had completed the first deal, we'd be in that range. My legal bill was $100,000. We paid another $5,000 to the Pennsylvania attorney to opine on that legal opinion. And of course, we get to pay the lender's New York attorney as well. The lender's New York attorney was $50,000. So we paid, in round numbers, $155,000 just in legal fees on a $3 million transaction. Absurd. Absolutely absurd. Yes, cash up front at closing. So, did I have any cash? Did I put up any cash up front? No. No. But then again, I've known the managing partner for this law firm for a long time. And I said, Michael, I need your help. I said, I don't want you doing it because you're too damn expensive. Give it to one of your good M&A associates. I'm sure they'll do a fine job. And that's what he did. So we had an associate running the deal for us. If Michael himself, the managing partner, had done this deal, it wouldn't have been 100. It would have been 150 easy on our side. Michael's great, but again, this is a simple little transaction. I didn't need Michael. In fact, I could have done it myself, but anyway, but I couldn't write my own legal opinion, I guess. So that's kind of the anatomy of that deal. Let's see if what kind of questions I've got coming in, so I can just answer anything that might be here. Could you please repeat the term sheet details? Let's see, that was 14 minutes into the call. So I assume the term sheet with the, term sheet with the buyer or with the seller or with the lender? Just shoot me back a message and I'll get back to that. So a term sheet is not legally binding, question mark. That is correct. Term sheets are never legally binding. A letter of intent is not binding. In fact, in the letter of intent or a term sheet, it'll say right in there, this is a non-binding letter of intent. Generally, the only thing that survives a letter of intent that doesn't go anywhere is the confidentiality piece of it. Then it'll say it right there. So yes, letters of intent are not binding. They can walk out at any time. It's not binding until you actually have a deal signed and closed. Because literally what happens with the signatures, I told you I had already signed the deal, right? They had already signed the deal. But what happens with signatures don't get transmitted by the lawyers to one another, okay, until closing. So we didn't have Tim's signatures on the stock purchase agreement. They didn't have our signatures on the stock purchase. My attorney had ours, his attorney had his, and literally on Friday when it closed, we get on a conference call, everybody on a conference call. Okay, lawyer, you done? Lawyer, you done? Customer, you done? Client, you done? Okay, guys, thank you, congratulations, this deal's done. And at that point, all the documents get swapped, wires get started. All right, until then, nothing is binding, nothing at all. So that's how New York lawyers make money, making up irrelevant questions. Absolutely. Absolutely. I mean, these guys are just incredible. Legal fee. So the closing is kind of on a contingency. Well, maybe. I don't know what would have happened to that bill if we had not closed. That was very bothersome to me. I mean, I had a conversation with Michael, the managing partner, early on, and tried to make it sound like contingency, but we never really pressed that point. And so look, I mean, if it had been a $20,000 bill, I mean, he would have just, I'll get you next time. But at $100,000, I don't think he would have said, I'll get you next time. I'm going to get you right now. Why did you have to pay lenders legal fees? Is that the norm? Yes, it is the norm. Basically, you get to pay everything. Aren't you lucky? And effectively, it all becomes part of the loan agreement. Okay, so, I had budgeted in $200,000 for expenses. It turned out to be $380,000, but I'm partially to blame for that. Oh, yes, by the way, my firm took a fee of $150,000 as part of that $380,000. So outside of that, we had $230,000 in expenses, and and I had budgeted $200,000 to include a portion of our fee. So, but yes, it is the norm. How is a no cash deal done if you had to raise $1 million? How do you raise it? Well, I haven't raised anything yet. Now, we did this deal with zero cash. The question now becomes, what do you do with the balance sheet? All right, we now own it. We have $2 million in debt. We've got 3.5 million less in cash than we used to have. And what do we want to do? Well, I want to strengthen the balance sheet. There's another acquisition I'm already in diligence on that we'd like to do. It'll be an $8 million revenue company earning about $1 million a year. This company's not making any money. It immediately popped the whole thing to profitability. So I'm in diligence. It's, long way away, but in the next 60 days, we may close on a second one, maybe 90 days. But we do want to go out and raise some equity. So what we're doing, we valued the business at closing at $2.8 million. That's what we paid for it, right? Going forward with a private placement, it's not going to be at 2.8 million. It'll be at 6 million. It'll be back to 20% of revenue. And to that 6 million, I'm adding cash, actual cash balances. I'm subtracting off the debt. And we've got almost $500,000 of PPP debt, which should be forgiven, but it's not yet forgiven. So I'm subtracting off 2.5 million and then coming up with a net equity value. That's the value that we'll go out and raise the $1 million for. So we'll give up about 10% of the company for $1 million, maybe 11%. All right, and we're already in discussions with individuals. Funny, Kevin was talking to a couple of friends of his and just telling them what we're doing. And the first guy said, "What?" Before Kevin said anything about raising money, he said, can I buy $50,000 worth? You want to invest 50? Yeah, I'll invest 50. Guy on the phone with the next guy, same thing. Didn't even ask. Can I do 50? I'd love to be part of this. I'd love to be part of this. I've got 50 to invest. So we raised 100 without doing anything. I'm in the process of writing the subscription agreement. Those are pretty much done. I'm also doing a confidential informational memorandum. Remember, I've posted up a couple of informational memorandums on the website. So I'm writing one from scratch for this business, and that'll be ready, I hope, sometime next week. And we're going to go out and talk to friends and family and hopefully raise a quick $1 million. And give up a tiny little piece of the company. So why do we do it that way rather than the other way? Why didn't we do that up front? Well, if we do that up front, in round numbers, it's a $3 million transaction. All right, 1 million of that 3 million is a third. Even if you say, well, post money is 4 million, so I'll give you a quarter. Instead of giving up 25 to 33% of the business, we're going to give up 10 or 11. That's why you do it this way. How did you raise it and from whom? People that we know. I mean, we're just going to get on the phone. I mean, I haven't told anybody yet, really in my circle, that we've completed this deal. I've been here doing what I need to do, at the location. And by the way, my role in this, I'm going to tear apart every single piece of this business and analyze it. Yesterday, I was working on the warehouse. By the end of the day, I'll know precisely what it costs to run this warehouse for orders coming in, returns, the whole 9 yards. And so when we start thinking about profitability of a customer, which will be the next thing, we know that if I ship that customer, $10,000 of the books, I know my warehouse cost for doing that is X. So I'm not going to just look at the gross profit. I've got 14-point gross profit. That's nice, but what else do I have? I've got warehouse costs. I've got shipping costs. I've got other things going to come out of that gross profit. So what am I really making on this? And by the way, if you're a customer that returns a bunch of books, what's it cost me to take those books in? And then I've got to return those to our publishers. What does it cost me to ship those to the publishers? So it's a 3-step process to figure out, is that order profitable or not? And which of my customers, are really profitable? Which of my customers am I losing money on every time they ring my doorbell? I mean, we need to figure all that out. And so anyway, the first piece of that is you got to figure out what the warehouse costs. So I'm getting pretty close to that. Here we go. Can you go into why you plan to raise $1 million in equity for the business? Yes. We are servicing universities. We sell to university bookstores. In the United States today, probably 95% of university bookstores are closed. Our customer is closed. That is not good. So what percentage of those bookstores are going to open up for the August semester? Beats me. I mean, we work with the major management companies. Follett manages 1,700 bookstores. Barnes & Noble had 800 bookstores. We know what they think, and that's probably a good proxy for the entire industry. But it's probably going to be somewhere in the 60, 70% range that open, leaving 20, 30% potentially that are not going to open. Well, how do that 30%, how do we get books to students? Our Amazon business has more than doubled since this whole COVID thing started. We're going to take one of our people here who manages, kind of the Amazon business on a part-time basis. In a few days, she's going to be full-time managing Amazon. We're going to blow up Amazon. We're going to put resources, and then into Facebook marketing and all that stuff to drive volume in Amazon to our books, to students that are going to, Kevin and I were having a conversation about this morning. I want to know what bookstores are not run by the big management companies. Why? Because if I sell books to a student that normally would get their books from a big management company, I'm competing with my customer. I do want to do that, but I don't want to do that today. So I want to know what schools are not managed by a professional manager. Of those schools, which schools are not going to open their bookstores? Now, and then also give me a listing of how much sales we did with each one of those stores, each one of those universities, and so we can prioritize from top to bottom. Then we're going to go out and use Facebook advertising to directly advertise for students that go to that school where the bookstore is not open and they're not managed by a customer. What's the impact of that going to be? I have no clue. But that is, when you talk about low-hanging fruit, those are the people that we need to get to, because those are the people that are going to need books and they can't get them from their university. So that's the kind of stuff, that we're working on. So to raise the equity. So for equity, right now the business has $2 million of debt and, another $2 million tied up in cash that we can't use. So, first, to do the SBA deal is important to get that restricted cash released. But secondly, this business is so uncertain right now. We don't know who's going to open up. We don't know who's going to buy, who's not going to buy. We don't know any of that. We can guess, but the historical financials, the historical rates of ordering, is not going to be the same this year. It's certainly not going to be better. It's probably going to be worse, but is it worse by 10%, 20%, or 50%? We don't know. We've got a pretty good fixed costs sitting here. So if we're down by 50%, we're losing our ass. I better have capital to cover that cost. That's why we're going out immediately to raise at least $1 million. And frankly, I'm going to follow that up with a Reg CF offering probably in the fourth quarter for another $1 million. Can I get on the mic for my question? I want to meet each deal. I will come back to you, Liam, I promise. Do you recommend prepaid legal services? Yeah, for some stuff, but not for this kind of thing. Term sheet. Quote was addressed for your audio got garbled. The question has been addressed. Oh, great. Thank you. I want to enter a company and take over 60% of the shares. As an asset-based loan on the ownership company being purchased possible? Yes. The owner stays with 40%, but the loan is for the company So also for him, what other structure would be better here? All right. All right, if you do SBA in this case, where you own 60, he owns 40, both of you are going to have to guarantee it. Okay, so just know that up front. On an asset-based deal, yeah, I mean, he's just going to need to know what the deal is, and that is he's going to get cash for his 60%. His 40% will continue going on in the business, and there's going to be debt associated with that. And you can do some pro formas and show him what that means for him. Other structure, I was thinking a second that you could create a new co that actually owns the 60% and get the loan through that new co, and that may be possible. You just have to work with the ABL lender to say, is that possible? Because what that does then, it keeps the debt off the books of the acquiring company. In fact, that's what we did. We created an acquisition corp. We loaned the money, we borrowed the money at acquisition corp. The book distribution company paid down acquisition corp, that $1 million that we paid down at closing. And now on their books, there's an intercompany loan of $1 million from the book company to the acquisition company. When you consolidate it, all that goes away. But for the structure of the deal, that's what we did. Would you pay yearly dividends to investors or just give them equity? In our case, we're just giving them equity. You can do a preferred deal, preferred stock deal. In a C Corp, these happen to be S Corps. You can only have one class of stock until we flip it to a C Corp. Sorry, I didn't get how the company value changed pre and post sale when speaking to family and friends for extra cash. Well, now you see it, now you don't. I mean, it's a little sleight of hand, but I mean, there'll be disclosures that we paid $2.8 million of business, but we are going out at what we believe is a fair valuation for the company. And like I told you up front, I thought a fair valuation up front was $6 million. I'm pretty sure Tim got an offer for $6 million he turned down. And so again, I don't think anybody's going to argue that a $30 million business with all this potential is worth $6 million. And then from there, we add cash, subtract debt to come down to an equity value. How do you justify 150 in acquisition fees to the lender? Is that discounting the equity required by the lender? I'm not sure about the second question. I look at it like this. I've worked 8 months on this deal. My partners worked 8 months on this deal. We're going to split that 150. We're both getting 75. So on average, we paid ourselves less than $10,000 a month to get this deal done. The other way to take a look at it, if I'm an investment banker and I'm working on a $3 million deal, generally my fee is going to be 5%. Okay, if I'm working on a $300 million deal, my fee might be 0.8%. But, in small deals like this, a 5% deal. I mean, hell, if it's $3 million in real estate, you'd be paying 180. 150 to 180, 5-6%. So I have no problem with that. Discounting the equity required by the lender, I don't know what that means. Can't you ask the university for a list of students where the bookstore isn't opening up, then don't have to spend on Facebook? Yes, but you'll never get it. Are you wearing 2 hats, owner and broker investment banker? Yes, I was. Yeah. Yep. All right, now I'm going to go back to Liam somewhere. Actually, I don't need to do it there. I can do it here. See what question you have for me. Here we go. All right. Well, it says you're muted. Come on. There you go.
Thanks very much. How are you doing, folks? Right, so congratulations on your deal. And this one is kind of similar. So I'll just give you some numbers, right? So 2018, they did 1.2 in turnover, 173 EBIT. 2019 they did 1.5 and 116 EBIT. So both directors are working, husband and wife. They're both working in a business. I've subtracted that at 60k, so 30 grand each for their replacements. So that comes down to 89k EBIT, and times 3, to be fair, 267, right? So 267 purchase price agreed. Right. They don't. I've told them it's not going to be a cash deal. There will be no closing payment, right? So it will need to be deferred. He's happy with that. I was very surprised that he's going to take this. He seems highly motivated. Problem is, so one of the reasons I can't get a closing payment is the debt factoring. So they've got factoring invoice finance. I don't know what it's called in America. So it mentioned 300k. I don't have this confirmed, but they're paying about 40k a year to Lloyd's banking. Right. They have, according to the 2019 books, they have about 300k in inventory. They do. They put vending machines in machine shops for tooling. So they've hardly been affected by this whole thing. It's a really good system they've got. It's electronic. Someone goes in, fills it. I am not sure. I don't have a clue how to structure the deal. I've not included any money for myself to take a salary. I've not included in lawyers' fees or accountants' fees. Right. Any advice?
Okay. All right. So, what kind of assets does the company have?
It has very little. I can tell you right now. The stock. So the debtor book. We can't use the debtor book. It would appear, but on this ledger, they sent me the aged debtors, and the total was.
I mean, do they have any real inventory, receivables, any of that stuff? Sounds like no.
Yeah, 300. On the books here, on the main books, they've got 339 in stocks, so inventory that they bought.
Okay, inventory. All right.
Why are you asking about this? They don't necessarily, because they're happy not to take a closing payment.
All right, so they're not taking anything at closing, and so you're going to pay this out just over time.
Yes. Well, that's the plan, unless the broker's involved, right? But the broker has already pissed the guy off and me, so he looks at it. He'll just tell me.
There you go. Well, look, the broker was hired by the seller, was not hired by you, so it's not your problem; it's his problem.
Yeah.
All right. So if you guys can come to an agreement on that, whatever the price is, it's going to be on an earn-out basis, or you're going to pay him out over time.
Yeah.
That's great. I mean, you're going to need to get somebody to paper that for you.
Yeah, that's what I'm concerned about. Yeah.
Well, fine. I mean, it doesn't sound like a complicated deal. Find a lawyer that can do that for $5,000 or $10,000.
Okay. And accountants' fees, I'll just need to get them to. They would take. Well, I can just negotiate and see if they'll take the whole thing deferred, because we'll need to wait because it's a good running business,
Right. Well, look, I mean, my guess is the accounting for this thing is pretty simple. All right, so it shouldn't take a lot of time. I mean, yeah, when they do their taxes, do they hire an accountant?
They've got an accountant, yeah. I've got a call with them next week, hopefully.
There you go. So, I mean, to the extent that you trust this guy, use the accountant. Okay, tell me what I need to know, about this business. What don't I know? Are there liabilities sitting out there I don't know about? That's the biggie.
Well, just the invoice finance, he said that they're due the bank 300k. So what he wants is for me to take on the debt. He said any creditors that are rolling with the business, he wants me to take it on with the business, and he gets paid over time.
Okay. Does that make sense?
Straightforward, yes. Okay.
There you go.
All right. So I'll just deduct it back. So should I, when I'm doing when I'm focusing on the structuring, I'll just subtract back my salary. All right, right. No worries. You might not like it, but I'll just. All right. Cheers.
Hey, if it works for you and if it works for the seller and you're not taking on liabilities you don't know about, go for it.
All right. Okay. So I'll just make sure I know about that. Okay.
Make sure you know what you're getting into. Yes. That's always
all right. No worries. Thanks, Jeff. Right. Cheers.
All right. You're welcome. All right, guys. Oh my God, I've got a couple more questions down here. I'm going to see if I can take these or do. Oh, so you mentioned the SBA lender allow you to use $500,000 as equity, so that'll discount your 150. No, the $1 million we use to pay down the loan, the SBA is going to deem that to be equity in the business. How do you get a loan for a new company that does not have any history? If it is a brand new company, the answer is you don't, unless there's a lot of equity coming in, a lot of cash. I might have missed this, but did you give equity to the management team? Not yet, but we are going to put together a stock option plan in the next 60 days. So each of the top 4 people will have the opportunity to get equity. It'll vest over 3 years. All right. I think that's it, folks. We're a little past time. Thank you so much. Hopefully this is very instructive, and you guys learned a lot today. I will talk to you later. See you guys.
Congrats, Jeff.
Congrats.
Thank you.
Thank you.